I think a lot of real estate investors just don't understand the difference between how your W-2 job income is taxed versus your taxes on real estate rent. Can you talk to us about that?
Yeah, for sure. So the reason it's confusing is because they're both considered ordinary income, right? The difference is that one is business income and one is non-business income. Your wages are non-business income. You don't get deductions against non-business income, but you do get deductions against business income. So your rental income is considered business income for purposes of the Internal Revenue Code. What that means is you get deductions for taxes, you get deductions for interest, you get deductions for maintenance, you get deductions for depreciation, right? So that's why when you have your income from your rentals typically taxed much lower than your income from your salary, because you get no deductions against your salary like you do against the rentals.
Maybe it would help to introduce an example here. If a real estate investor has, say, a single family rental property with $2,000 of rent income, a $1,000 mortgage, $800 in operating expenses, how is that taxed? That leaves them with $200 of cash flow.
You have $200 of cash flow, but then you probably have depreciation on top of that, which is a non-cash deduction. And so let's say your depreciation is $500. That means you actually have a $300 loss that in many cases you can use to offset income from your W-2. So you actually have a negative tax rate. In other words, you're making money, okay, from taxes. So it actually is an increase to your cash flow. So it's a way to think of it is I have $200 of cash flow from my tenant. If I have a $300 loss for tax purposes, and I'm in a 33% tax bracket, I have $100 of income from the government. So that means my cash flow is really after tax cash flow is $300, not $200. Whereas if you have the same $200 of income from your wages, okay, let's say you have just the net, right? Let's start with the net. You have $200, well, you're gonna be taxed. And let's say that, again, your 33% tax rate, that means your after tax, right, is gonna be roughly $130. So $130 versus $300. So it's like twice as much. And it's because a lot of that difference, in fact, all of that difference is because of the tax law.
Gosh, that was a great breakdown. I'm really glad that I introduced that example. $2,000 in rent minus $1,000 for the mortgage and $800 in operating expenses, again, leaving you with $200 in cash flow. With that example, there's probably more going on here with taxes because, of course, with that $1,000 mortgage amount, some is going to be principal, some is going to be interest, and part of that interest can be tax deductible.
Well, I'm assuming it's all interest, because if it were not, we'd have a higher taxable income. Remember, your principal payment is not deductible. So right. In your example, I was assuming that the $1,000 mortgage payment was all interest. If it was only $800, then you'd have $400 of income before depreciation. You don't have $100 loss, because remember, your principal is not deductible. So therefore, you have to add that back into your taxable income.
All right. Will you talk to us about how to apply depreciation to this income versus expenses example? Is there anything else you can speak to when it comes to that $800 of operating expenses in this example? And those expenses include things like property insurance, property tax itself, maintenance, repairs, and utilities.
Right, but you could also, for example, you might run your rental real estate business out of a home office in your home. So you could have a home office deduction. You might use your car for the rental purposes, and then you get a deduction for your car. So there are additional expenses that aren't even in that $800 that you could pick up that would not otherwise, you'd never get a deduction, and you're really not spending any more money. You're just using it for business and therefore getting a business deduction. So it's really all about, what do I get to deduct? Remember that if you own a home for yourself, you don't get to really deduct the taxes. You have a limit on how much you can deduct. So taxes are limited in deduction. Mortgage interest may or may not be limited. Remember also that if you have a mortgage, you're limited to how much a $750,000 mortgage being deductible, right? Whereas if it's a rental property, it could be a $7.5 million. and mortgage, and you still get the deduction. So you're not limited like you are. On top of that, again, it's a business. So let's say that you put solar panels on your personal home, you'd get a 30% tax credit, but you'd get no depreciation deduction. If you put solar panels on your rental house, you get the same 30% tax credit, but now you also get a depreciation deduction of another $30,000, $40,000 in the first year. So there's always more deductions in a business setting than a personal setting.
You can watch this one next.